folks. Welcome to Paisa Vaisa. I'm your host, Anupam Gupta, P50 on Twitter. Really thrilled. Always good to have a mutual fund in the house, and more importantly, one of the oldest financial distribution groups in the country. The NJ Group is on this episode. I'm talking with Rajiv Shastri, CEO, NJ Asset Management, and we're going to talk about rule investing and much more right after this short break.
Hello, everybody. It's been another great week on the IVM Podcast Network. On Paisa Vaisa, Anupam talks to Dr. S. Prakash. He's the Managing Director of Star Health. They discuss the different types of health insurance. We have a new show, Cyberpoint by Checkpoint. Shiladitya Mukhopadhyay talks to Prakash Bell. He's the Head of Security Engineering at Checkpoint Software Technologies. They discuss phishing, what it is, and how one can stay safe from it. On Probation se Promotion Tak, Abhinav Trivedi discusses some basic personality hacks to convert your work insecurity into your strength. On Storytellers and Story Sellers, Saloni Gaur and Neil discuss the world of influencer marketing. On Cyrus Says, Cyrus is joined by Samir Nair. He's the CEO of Applause Entertainment. They discuss Samir's body of work in the Indian television and OTT space. And on Marathi Khidkitun, the Deshmukhs decode M.M. Deshpande's poem, Karat Nahi. Once again, I'd like to remind you all, please do check out our merch. It's available on IVM Podcast website. Go click the shop tab and you'll be able to see our first collections of t-shirts. Do follow us on social media. We're IVM Podcast on Twitter, Facebook, Instagram, and LinkedIn. Remember, we got a bunch of YouTube channels as well. And if you want to check that out, go to our website, ivmpodcast.com/YouTube. We have a list of all those channels. And remember, do tell a friend if you're enjoying this show or any of our other shows for that matter. Word of mouth is one of the most important and best ways for us to get the word out about this podcast. Also, it's a way for you to have discussions about a podcast with your friends. And finally, we'd like to thank our sponsors this week, Boat Lifestyle, Checkpoint Software, Small Case, and Intel vPro. Thank you so much for making this possible.
And welcome back. Rajiv, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
It's an honor to be here, Anupam. I listen to your podcast quite often, and you've had a few friends of mine on it.
So very kind of you.
It's always good to be here.
And it's good to have the NJ Group. Not many people know about them because Neeraj Bhai, Jignesh Bhai are these, very reclusive people sitting out of, where is it? Ahmedabad, Surat?
Surat.
It's sitting out of Surat, and they've created this massive group in less than 30 years, or probably just more than 30 years, 1994.
So, just about 27 years, a little more than 2 decades.
Tell us about that, Rajiv. Let's start from there, because NJ Asset Management is named after the NJ Group, and they were formed in 1995. They've come a long way. 95,000 crores of assets. Tell us about the story.
Close to 120,000 crores actually now contributed to the mutual fund industry. So they started off as a traditional, sales distribution house, and very quickly realized that if they wanted to scale up, a platform model was, a much better way to go, where they would, serve as a platform to allow other distributors to come in and serve investors rather than doing all the selling themselves. And, it realized they dedicated themselves to empowering others to be able to sell, and focused on selling concepts rather than, any product. They pioneered SIPs in the country. They pioneered asset allocation in the country. Much before these were themes that the mutual fund industry picked up. They spoke about it, and they spoke about it consistently. And, they sold these, they trained their partner force in these concepts and then left the selling to them. So it's just been about consistently doing the right thing that has got them to this place.
And they survived the entire shift from regular to direct, and the mutual fund industry going through so many transformations in these 28 years. Whether it is the whole first entry load going away, regular to direct. And they've still stuck to their principles, right?
See, the principles are more with regard to how you manage the behavior of the clients rather than, just about being an expert or selling the right product. It's never been about that. It's about long-term investing, focused, dedicated, disciplined investing, being there for, time in markets more important than market timing, and, things like that. And that's what they work. That's what works for them.
Yeah. Tell us about the AMC business, right? Because that would be getting the same values from the group and a bit of a crowded place, and what was the thinking behind that?
See, it appears to be crowded. Yes, I mean, there are 44 players, right? But it's not yet a mature industry. There are mature players, no doubt. I mean, there are people who've been around for, more than 2 decades now, and they're very large, very mature players. But these guys, but the market is still a very, very nascent market. uh, we reach a little over 2.5% of our population. We are roughly where banks were in 1970. And the growth that banks have seen after that, banks were about 13-14% of GDP. Bank deposits, they reached about 1.5% of the population. From then to now, deposits as a percentage of GDP have gone up to 75%. So that's like a five-fold increase. But that's not the real story. The real story is GDP gone up by 200 times. So by 400 times. So what you're looking at is a 2,000-fold growth in bank deposits, and that's what lies ahead of us. So there's a lot of work to be done. There's a lot of room for more people, and more importantly, while it seems that the concentration in the top 10 and the top 5 remains pretty much intact, the composition keeps on changing. There are new players who come in, older ones go out. So there's always room for more people.
Rajiv, I want your point of view on two specific points. One of them that I just raised right now, direct versus regular and active versus passive. Direct versus regular. First, let's talk about that, because when the direct product was introduced in 2013, a lot of people thought that that's it. Distributors are dead and people can make their own choice. But I'm of the belief that there is definitely some amount of handholding required out there. In what form and chip and at what cost, I don't know. So let's talk about direct versus regular first.
Okay. So I'm a firm believer in what you just said, that, you need someone to help guide your investments. It's not about that person being an expert. It's just about that person being able to manage your behavior. See, human beings are emotional, right? We don't like it when we lose money. We get elated when we make a lot of money. And that's when we make mistakes. So you need to have an independent person, managing our emotions, so that we don't get too emotional as a result of our investments and, don't end up making the mistake. So it's, I think, more about managing the behavior of an investor rather than anything else. And I think that is far more valuable than any commission that one might pay or anything, because equities create wealth over the long term, right? But stresses come over the short term, right? Investments can cause considerable stress over the short term. And that's the dichotomy that, MFDs and advisors can manage. So I'm a big one in favor of distributors always.
Yeah, what would be a normal counter to someone who says that there is a misalignment of incentives and the distributor will only sell the products that have the highest commission? I mean, you have any opinion there?
Yeah, well, if a distributor is serious about building their business, okay, they would naturally align themselves with the investor, because it's the investor who gives them business. It's not the, while they're being paid by the mutual fund industry, but it's the investor who's giving them the business. So if a distributor is serious about building a long-term business, there's no way that they will allow, a small thing like the fact that a mutual fund is paying them to defocus them from the goals of the investors.
Yeah, let's get to the next hot potato: active versus passive. This debate didn't even exist back when 10 years ago, 15 years ago. This wasn't even a thing. What do you think about that? Because right now the biggest mutual fund scheme in India is a passive scheme.
Absolutely.
Okay, of course, helped by the fact that there's EPFO money flowing in there, but still, and passives have really taken off in the last 3-5 years. There might be a separate set of reasons for that we have spoken about on the show. But your view on this debate?
So, one of the things you pointed out, that EPFOs being a major contributor to passive funds. And that is where, so there are largely two types of investors in the world. Is one who invest for themselves and people who invest for others, like treasury managers of provident funds, institutions and things like that. So there are people who are investing other people's money. So for the latter, what happens is that they don't get any benefit from the outperformance. No one comes and, rewards them. If something outperforms the index, if their investments outperform, no one comes and rewards them. But if their investments underperform, they have 10 questions that they need to answer. So their incentives are stacked towards ensuring that they don't underperform. They don't care whether they outperform or not, right? And for that, passive funds are absolutely perfectly suited. So institutional investors, without any doubt, should and will always gravitate towards passive funds because their incentives are stacked for that. Now, coming to individual investors stand to gain if their investments outperform. And, investing in passive funds guarantees that they will never outperform. Okay, it guarantees they'll never underperform, but it also guarantees they'll never outperform. And why is that important? Why is outperformance important? So let's just take a small example. Something that cost 1,000 rupees in 1986 would cost roughly 10,000 rupees now. That's about the CPI inflation that has happened. If you'd invested 1,000 rupees in the Sensex in 1986, it would be worth about 1 lakh right now. So the wealth that has been created is 90,000 rupees. It's a lot of money. Right? I'm not saying it's a small amount. It's a lot of money. But a 2% outperformance through that period would have doubled the wealth. So the impact of outperformance on a person's wealth at the end of it is absolutely spectacular, especially when you're investing for the long term. And that's one of the reasons why individual investors need to give their portfolios at least a chance to outperform. There's no guarantee. There are no guarantees. But they need to give it a chance, because if that happens, the impact on their wealth, the wealth that they create at the end of 30, 35, 40 years is absolutely spectacular.
And the point that you made on time in the market was what's called time in the market versus market timing first. Second is what's called the behavior gap.
Absolutely.
Which is the fund performance and my performance as an investor. Where are the gaps you see from the investor's perspective? Why they do this? Because we're talking at a time where Prashant Jain has, hung up his boots, and it's a huge event.
Absolutely.
Probably for people who are in the industry like yourself, people like, who are tracking it like me. People who are on the outside probably don't understand the importance, but it's like an entire school of thought that has, I don't know whether it's passed on or not, but your views on this investing gap, market timing, long term, and what are the mistakes that investors make?
So I think the biggest mistake that people make is to target returns with their portfolio rather than target the risk. And that is where I think, it all boils down to that eventually. When, in the midst of a bull market, people always overestimate the risk appetite. In the midst of a bear market, they always underestimate the risk appetite. If one maintains a consistent risk appetite and invests based on that risk appetite, okay, they're almost sure to succeed, right? But it's just that difference that, making sure that you're investing based on your risk appetite and keeping your risk appetite consistent. I think that's the behavioral gap. It manifests as greed and fear. Okay, but the managing that part is by far the most crucial thing.
Yeah, just one last question before we go into the break, Rajiv. Do you think the products in the mutual fund industry now, in the year 2022, the private mutual fund industry, so to say, is about, about between 25 and 30 years old. Do you think the products are now really suited to what the investors want, and now it's on the investors to adjust to their personal risk return profiles and invest?
So, well, yes and no. I mean, there are two ways to look at this. One is that the mutual fund industry in many ways has offered just plain vanilla products, right? Products that, pass on investment risk right down to the investor, and it's up to the investor to manage the risk and everything that happens. But recently, probably over the last, 5 years or so, we've seen the emergence of things called like the balanced advantage fund, which dynamically adjust asset allocation based on market conditions and things like that, which kind of give investors the comfort that even if they remain invested, they're not going to be very out of sync with the market, right? So I think the products themselves are changing to adapt to investor requirements. Obviously, investors do need to manage their own behavior or need to have someone else manage their own behavior. So basically. Yeah.
So folks, on that note, we're going to take a small break. On the other side of this break, we are going to talk about rule-based investing, about the products that NJ Mutual Fund has got, and much more. So don't go anywhere. We'll be right back.
Hello, everybody. It's been another great week on the IVM Podcast Network. On Paisa Vaisa, Anupam talks to Dr. S. Prakash. He's the Managing Director of Star Health. They discuss the different types of health insurance. We have a new show, Cyberpoint by Checkpoint. Shiladitya Mukhopadhyay talks to Prakash Bell. He's the Head of Security Engineering at Checkpoint Software Technologies. They discuss phishing, what it is, and how one can stay safe from it. On Probation se Promotion Tak, Abhinav Trivedi discusses some basic personality hacks to convert your work insecurity into your strength. On Storytellers and Story Sellers, Saloni Gaur and Neil discuss the world of influencer marketing. On Cyrus Says, Cyrus is joined by Samir Nair. He's the CEO of Applause Entertainment. They discuss Samir's body of work in the Indian television and OTT space. And on Marathi Khidkitun, the Deshmukhs decode M.M. Deshpande's poem, Karat Nahi. Once again, I'd like to remind you all, please do check out our merch. It's available on IVM Podcast website. Go click the shop tab and you'll be able to see our first collections of t-shirts. Do follow us on social media. We're IVM Podcast on Twitter, Facebook, Instagram, and LinkedIn. Remember, we got a bunch of YouTube channels as well, and if you want to check that out, go to our website, ivmpodcast.com/YouTube. We have a list of all those channels. And remember, do tell a friend if you're enjoying this show or any of our other shows for that matter. Word of mouth is one of the most important and best ways for us to get the word out about this podcast. Also, it's a way for you to have discussions about a podcast with your friends. And finally, we'd like to thank our sponsors this week, Boat Lifestyle, Checkpoint Software, Small Case, and Intel vPro. Thank you so much for making this possible.
And welcome back. Rajiv, now let's talk about NJ Mutual Fund, the core concept of rule-based investing. There's a very nice ebook that you've got on your website, like some 54 slides, and it is so good. I would encourage our listeners to go on the NJ website and check out that ebook. It's very detailed. Let's talk a little bit about that, the principles that you've got out there, rule-based investing, factors. Some of this is very different from passive and what people understand. So let's talk about that.
Okay, so let's just step back and look at how investment management came about. In the initial phase, there were only experts who were managing money for people. There was nothing called passive, right? As time progressed, indexes emerged to kind of get an aggregate view of the markets up or down. We talk about the Sensex or the Nifty. Right? We're not talking about each of the 6,000 listed stocks. So indexes were created, and as computing power increased, portfolio managers realized that they could replicate indexes quite efficiently. And since there was no decision making, since they were just replicating something, that came to be called as passive investing. And in contrast, the traditional form of investing came to be called as active, right? Now, passive investing, as as I mentioned earlier, guarantees that you won't outperform. Okay, but it is a very disciplined way of investing because there's no way that you can change anything. You state that you're going to invest in a particular manner and you invest in a particular manner. Active investing offers the potential of outperformance, but it's always subject to human biases because there are human beings who are managing it. Rule-based active investing, as we call it, sits in the middle of these. So it has the discipline of passive investing, and it eliminates human biases so that we don't end up, making the most common, bias-driven mistakes that happen. Now, when we talk about rule-based active investing, the next thing we talk about is factor-based investing. And, factors do sound very jargony and it can be intimidating, and people get, it feels as if we're trying to do something that's unnatural and, not outside, not the way that human beings are used to behaving. But that's not actually the case. Factors are, human beings are very tuned to thinking about factors. Think of factors as features. Right. So when you buy a car, you look at 5 features about the car, and then you decide a good balance, a good mix. You buy a home, you do the same thing. Buy a phone, you do the same thing. Similarly, for stocks, there are 4 factors that we take into account, which are quality, value, momentum, and low volatility. And these 4 factors, we try to find a good mix of those for our portfolio. Right. So it's multi-factor investing in that way. And basically just that's it. That's how we go about creating a portfolio. We just target to find out what factors exist in a portfolio based on the data that they've generated in the past. We don't have any subjective judgment on them. We see the data, we analyze vast amounts of data using very advanced techniques, identify rules, and then the rules select the stocks. So we don't select the stocks, that cuts out the bias. And that's how a portfolio gets created. Now, there's very little awareness about this method of investing in India. It's been a vastly successful way of investing internationally, and that was one of the reasons why we published the Factor Book. So the website njfactorbook.com has the Factor Book available for free as a download, and a PDF version keeps on getting updated as well. And it was just our humble beginning trying to spread awareness about what we're doing and how we're investing.
Listeners can make their own factors. Like they might choose low debt, high cash, some kind of framework, and then
absolutely. See, anything can be a factor.
Right.
Okay.
Right.
Whether the MD and CEO, prefers tea over coffee can also be a factor. But the thing is that we need to figure out those factors which have a significant impact on performance. And these 4 factors have proved internationally to be the most significant contributors to performance. So that's value, quality, momentum, and low volatility, along with size. But size doesn't work in India because we don't have liquidity at the lower end of the market. So size is a bit of a problem. But these four have proved to be, very comprehensively successful across the world and across time.
Let's go one bit deeper in that. What products do you have right now? What schemes does NJ Mutual Fund have? And the four factors that you mentioned, just maybe a few lines on each of them.
Sure, absolutely. So we have combined across our portfolio management service and our mutual fund. We have 10 investment approaches that we offer on the portfolio management platform and 3 schemes that we offer on the mutual fund platform. Across these, we manage about 8,500 crores, which makes us one of the largest, it makes us the largest factor investing house in the country. We are a dedicated factor investing house. We do not do traditional management at all. So our focus is on ensuring that we have the highest quality data, the highest quality people to analyze that data. So we have data scientists, we have database specialists, we have financial technologists, people who are just working on analyzing the data and trying to identify the factors that we want. Now, there are 2 ways to go about factor investing. And let's just talk about the factors first, and I'll come to multi-factor investing. So, in the equivalence of the car industry, let's look at the factors in the equivalence of the car industry so that, it stays in the mind. So, quality. And you say quality, for example, most people will think about a Mercedes, a BMW, a Jaguar. Right? The idea is that it's made well. Right. There's a significant overlap with low volatility and quality because quality stocks are also low volatile. Quality cars are also more reliable. So, just looking at low volatility as reliability, the quality cars are also more reliable. So, you have these cars. They're certainly not cheap. Okay. And they're not the fastest cars on the road, but they are very high quality. They're built well. They're very reliable. So, that's the quality factor. Then you have the value factor. So, in India, the value factor is, typified by Maruti, Tata, right? Certainly, not the highest quality, certainly not the most reliable, but if they do give trouble, it's very cheap to fix them. It's very reasonable to fix them. They're not the fastest cars on the road, but they're very good value for money. They're available at a reasonable price and, one can just blindly buy them without worrying as if they'll cost too much. Coming to, low volatility, like I said, significant overlap with quality, but then low volatility in India, one can say is typified by a Toyota. Car that's reliable, it'll start, it'll last, a couple of 100,000 kilometers at least, easy to maintain, built to a certain level of quality, not cheap, right? Not the fastest, but built for quality and reliability, right? And then lastly, we come to, momentum, and that's the most exciting cars in the world, the Ferraris, the Lamborghinis, and all of those. Absolutely. That's just speed, exciting, fun to have. And, not cheap, not the most reliable, not built to the best quality, but certainly lots of fun.
Yeah.
So investment factors are like that. I mean, all of these characteristics, you can just transport them directly to investment factors and they'll operate exactly in the same way.
Yeah.
Now, we can use one of 2 approaches. One is to build single factor portfolios, which means that, you can have a portfolio that comprises of quality stocks and things like that. And you can have a multi-factor portfolio. In multi-factor portfolio also, there are 2 ways to approach it. One is you seek a mix of all factors in all stocks, right? Or if you have enough money, then you go and buy the best stocks in each factor, right? So there are 2 ways to do multi-factor investing as well. So that's the way we invest. In our PMS platform, we have single factor portfolios because we're more discerning investors, people who are more aware of the risk profile, things like that. On our mutual fund platform, it's a retail platform, so we have a multi-factor strategy that we follow for the balanced advantage.
And how many products do you have on the mutual fund side?
3 right now. One is a risk category, which is the balanced advantage. We've just launched, in fact, today, we've launched the arbitrage and the overnight fund, which are more like facilities for our investors when they want to de-risk their portfolio.
I was going to ask you that. Do you have anything on the debt side? So you've got one equity scheme, which is the balanced advantage, and you've got 2 on the debt side.
Well, 2 on the debt side, but our debt investments are completely risk-free. We don't take any credit risk at all.
There's an ARB and a quality.
Overnight.
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 Overnight
So,
and up.
overnight
That's
and up,
pretty
yes.
much as you take away as much risk as you can from that.
As much we can. Yeah, absolutely.
Okay, and the balance advantage is again multi-asset, multi-factor approach. So
Absolutely.
you have equity and you have debt, and that moves as per the rules and regulation of the rules that you've set in for the mutual fund, right?
Yeah. So asset allocation is also rule based, and stock selection is also rule based. So everything that happens is based on a certain set of rules. It's rebalanced at predefined frequencies. So everything is based, happens in a very, very disciplined manner.
Did it manage to get this recent, what's happened in the last 1 year or between October and July, because you had the Nifty go from 18,100 to 15,100 and now from 15,100 to... I mean, as a retail investor, there is no way you can time all this because you're stuck in the
Absolutely.
noise of US Fed and rate cuts and rate hikes and all that. What's been happening on your mutual fund throughout
So
all
asset
this?
allocation has done very well. Our asset allocation has done incredibly well. Stock selection has also done well. We know that there is scope to make it better, and we are working on that. But it's been a very volatile ride. In fact, we launched at the end of October, so our first NAV was declared in November, and since then the markets have just been sideways. I mean, they just either up and down. They're not giving anyone even a breather right now. So
Because balance advantage is something what's called BAFs and DAFs, dynamic asset, balance asset, whatever.
absolutely.
Have some heavyweights out there, the ICICI and the HDFCs. Do they lean on you and say, you're a distributor of our products and you've manufactured themselves? Is there any competition there or?
So, there isn't, because we've chosen to differentiate ourselves so comprehensively. We're not, as an offerer of products, we're not saying that we're better than any of the people. Any active fund managers have done a wonderful job. They've created immense amounts of wealth for a lot of people. So we are not at any point of time saying that we're better. All we are saying is that this is a new form of investing, has become possible recently due to a confluence of data availability and computing power. Right? It offers diversification and complementarity that nothing else offers at this point of time. So just from that point of view, it deserves an allocation. We're not saying we're better or worse.
Correct.
We've never taken that line. I don't think we ever will.
It's like the auto industry you just mentioned, right? Because if I'm someone who's coming in to buy a car or whatever, and SUV, I have a price range and I have like 10 models and all of them have certain things that are good, some things that are bad, and it's become mutual funds become like FMCG products like cars and all. You've got a nice big range and then you've got to sit and choose, and that's probably where the distributor helps you.
That's where the distributor helps you. Also, what's happened is that, if you look at the investment style, there's largely been just one dominant style in our mutual fund industry, which is traditional active investing. Okay, passive investing, even despite the size that it's gathered, is still a very, very narrow industry focused on very, few set of institutional investors. It's not, there's very little participation from retail there. So, as far as the retail investors are concerned, they've got traditional active investors, and that's the style crunch, because everyone, then looks and sounds the same, right? And we need to do something different, and we have to kind of break the clutter.
It's a very lovely point you made, because not many, and especially a lot of people on the retail side don't get it, because this noise that has been generated by passive versus active. I mean, in my view, and my view only, I think India is an active market. Where we are in terms of size, depth, and all, we've got a very long way to go for us to even be matured. And for that kind of market, active has, a fund manager who knows how to analyze India and choose the right stuff. I think that's the future, really.
No, absolutely. See, the thing is, we've had this, period of incredible growth, economic growth, where at the nominal level, and I say nominal because corporate profits are nominal, and therefore stock price movement will also be in nominal terms. At the nominal level, the GDP has grown at between 12 to 15% very consistently year after year. That's inflation and growth combined, right? And we expect that to continue for another couple of decades, because we are in that high growth period. We still have to lift a lot of people out of poverty. There's a lot to be done. And if the economy is growing at that pace, there's always alpha to be found. There's always outperformance to be found. Once you get to a maturity where you're growing at 2% and you have inflation at 2%, how much alpha can you find? You're at a total return of 4% in the average across all asset classes. How much alpha?
That's what I'm talking about, folks. This is not investment advice. Okay, I'm just talking about my own views. Anyway, Rajiv, as we wind down the episode, what are your plans for the future? Any new products? You want to do something on the debt side? You want to explore the equity in a bigger way, or what do you have in mind?
So we are not a launch happy fund house. We'll never be. We will launch very differentiated products that are very clearly differentiated. We have one product approved, a flexi cap fund, 100% equity fund, which we are seeking to launch sometime in the near future. Let's see how that goes, because largely depends on market conditions. We will have an ELSS. Okay, at some point of time in the future, we will have rule-based debt funds when the debt market allows rule-based investments there. So at some point of time, we may have rule-based debt funds, but doesn't seem likely in the near future.
Debt market's making a lot of headway. You've got the RBI Retail Direct platform happening. You've got laddering that's coming into India. Sorry. Laddering is coming into India, has come into India. A lot of people, who understand debt can now actually make a 10-year kind of portfolio with each and every. You think debt has a long way to go also?
I think debt has a long way to go in two aspects. One is that the debt, the debt instrument is incredibly difficult for a layperson to understand.
Yeah.
Right.
Yeah.
So that's, I think, the biggest roadblock. So simplifying those instruments and focusing on zero coupons and single maturity instruments, those I think is the way forward. Let's see what happens with that. The second is that ensuring instrument level liquidity in debt is next to impossible, because each issuer can have multiple securities outstanding. The government, for example, has about 950 securities that they've issued. A handful of them trade every day, right? So ensuring instrument level liquidity is another challenge, and that will never happen. So we have to find ways around that to encourage retail participation.
See, I can understand you're from the mutual fund industry, because I hear very, very few people saying that debt is difficult to understand. A lot of people just come in, thinking what's with debt. You just have an interest rate, you have a duration, and that's it, you're sorted. And people think that equity is tough. Debt is tough.
Debt is, the instrument. You've got current yield, you've got yield to maturity, you've got, the clean price, the dirty price. There are so many variables.
And those are just the terms.
Yeah.
There are the way that the price reacts to interest rate events is something that you can't predict. And it's not even as, I think some parts of the debt market aren't as liquid as they probably should be. I don't know.
Like I said, instrument level liquidity is almost impossible.
Yeah, there you go. Okay, Rajiv, let's wrap up this episode into some kind of a checklist, So how should listeners choose their mutual funds? Okay, just a very generic level, because in an interview I heard, I read that you said that performance is one of the worst things to look at, which is a little bit, that's
controversial.
No, it's actually right. Come on, it's that every conversation about mutual funds is a simple, what's happened in the last 1 year, 3 year, 5 year, and then based on that you decide. So what do you think, what is a reasonably solid, durable framework for listeners to choose mutual funds?
So if one has the time and the inclination, understand the philosophy. And if that philosophy matches yours, then that's probably a match that's made in heaven. But very few people have the time and inclination. People like to read the numbers and choose based on that. If numbers are what you're looking at, I would say go with the risk numbers rather than the return numbers. Look at the ratios, look at the Sortino ratio. I think that is a very good guide. Decide where you want to be in terms of risk. Right? Don't, like I said, have a very consistent estimate of your own risk, okay, and invest consistently based on that. And that's all that is required for long-term success. And it's one of the simplest things to do, but one of the most difficult to implement.
Amazing, no? Because you are judging someone on his performance when you don't have your own risk return sorted.
Absolutely.
It's like saying that if you have confidence on India over a 10-year basis, and if that's the case, then even a passive would work for you. But then you start thinking on how the last 5 years spanned. That's what makes things more complicated for the investor. Whereas the mutual fund has pretty clear-cut products, right?
Absolutely. As far as our risk return profiles are concerned, we're very, very well defined. So we can't stray from there. Yeah. It's where the investors stray, which is what causes the gap between investor loss and investor return and the fund return.
How about that, folks? And that's probably one of the reasons why the NJ Group's distributor base. How big is the distributor base now?
In terms of our partners, about 27,000 people working with us.
27,000. Yeah. Partners all over India would probably make you among the largest in Asia, or if not,
It is. Well, we haven't really measured recently, but when we did, it was Asia's largest network.
Yeah, and the total asset, the mutual fund that have come through the NJ Group. Okay, obviously they don't belong to the NJ Group, but they're under advisement or whatever you call it. Is about 1 lakh. How much is that?
120,000 crores. Yes.
That is a lot, and that's happened over since 1994.
Yeah, absolutely.
So I hope that Neeraj Bhai, Jignesh Bhai are listening to this. If they are, my hats off to them. I'm a big fan of their work. But folks, that is a wrap on this episode of Paisa Vaisa. My guest, Rajiv Shastri, CEO, NJ Asset Management. Rajiv, thank you so much for joining us for this episode.
It was a pleasure. Thank you so much for having me.
Thanks, Rajiv. And listeners, thank you for listening to this episode of Paisa Vaisa. If you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcast on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter. And folks, really, thank you so much for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.